Ladies and gentlemen, thank you for standing by and welcome to Halo Labs Q2 2020 earnings call. At this time, all participants are in a listen-only mode. After the speaker presentation, if time permits, there will be question and answer session. To ask a question during the session over the phone, you will need to press star 1 on your telephone keypad. Please be advised that today's conference is being recorded, and if you require any further assistance, you can press star 0. I would now like to hand the conference call over to Catherine Field, President of Halo Labs. Thank you, and please go ahead.
Good afternoon, everyone. Thank you for joining us. My name is Katie Field, and I'm the President of Halo Labs, and I will be your conference moderator. At this time, I would like to welcome everyone officially, and let you know that your lines have been placed on mute. Basically, how this will go is we will have speaker remarks both from Kiran Sidhu, our Chief Executive Officer, and Philip Vandenberg, our Chief Financial Officer. And after both have given their remarks and presentation, there will be a question and answer session, and you will be able to submit questions. Before we get started, though, I would like to remind the listeners that certain statements made during this conference call presentation may constitute forward-looking information and forward-looking statements within the meaning of applicable securities laws. These statements involve known and unknown risks, uncertainties, and other factors which may cause the actual results, performance, or achievements of Halo Labs and its subsidiary entities, or the industry in which it operates, to be materially different from any future results, performance, or achievements expressed or implied by such forward-looking statements. When used in this conference call presentation, such statements use words such as may, will, expect, believe, plan, and other similar terminology, and include, among others, statements regarding expected operating results, future growth, anticipated capital expenditures, corporate strategy, and proposed acquisitions. These statements reflect management's current expectations regarding future events and operating performance and speak only as of the date hereof. Important factors that could cause Halo's actual results and financial condition to differ materially from those indicated in the forward-looking statements include, among others, economic and financial conditions, the ongoing impact of COVID-19, strategic actions, including acquisitions and dispositions, and Halo's success in integrating acquired businesses. These risk factors are discussed in detail under the heading Risk Factors in Halo's Annual Information Form dated April 16, 2020, and Halo's additional disclosure documents filed on SEDAR. New risk factors may arise from time to time, and it is not possible for management to predict all of those risk factors or the extent to which any factor or combination of factors may cause actual results, performance, or achievements to be materially different from those contained in forward-looking statements. Given these risks and uncertainties, investors should not place undue reliance on forward-looking statements as a prediction of actual results. Although the forward-looking statements contained in this presentation are based upon what management believes to be reasonable assumptions, Halo cannot assure investors that actual results will be consistent with these forward-looking statements. The company undertakes no obligation to update or revise any forward-looking statements, whether as a result of new information, future events, or otherwise, other than as required under securities legislation. I will now turn the call over to Kiran Sidhu and Philip Vandenberg, who will, first Kiran and then Philip, be presenting the financial results for Q2. Thank you.
Good evening, good afternoon, and good morning to everyone, depending on where you are in the world. My name is Kiran Sidhu. I am the co-founder, a director, and the CEO of Halo Labs. And what I'd like to do is change the way we've been doing these calls and focus more on overall strategy, where we've been, and where we're headed before we get into results. It's been a very challenging time for us, which started with the vape crisis and is continuing with COVID. And COVID, I would say, has been a personal journey, definitely for myself and Andreas, who both have, knock on wood, recovered from bouts with COVID. And so, I have a lot of sympathy and empathy for people who've suffered through this and what we're all suffering through, basically as humans with this pandemic. But the vape crisis and COVID has caused us to basically reshape the business. It was actually pivot or perish. And the first thing the vape crisis taught us was not to be solely dependent on our oil and concentrate business. So over the past 3 quarters, we have been aggressively diversifying our product offerings to include flower, pre-rolls, and edibles. The second thing it taught us was that given market conditions, to limit our scope. And what I mean by that is our geographic scope. So as on a North America basis, we're pretty much focused on Oregon and California. That being said, we have excellent assets in Nevada. Nevada suffered a little bit more from COVID, where California shrunk a little bit and Oregon's actually booming. So we've diversified our product offering into flowers, pre-rolls, and edibles. Edibles are, with the COVID crisis, what I can say in general, and specifically in Oregon and California, have been taking off. So we're really focusing, broadening our line there. The other thing I'm happy to report is that concentrate and oil demand has returned to normal levels in California and Oregon. In Oregon, it's actually growing, which has allowed us to turn back on Coastal Harvest, which was active in 2019 until about July or August of last year. Now with our super filtration in place and our B2B wholesale distillate business growing again, you should see some positive impact from Coastal Harvest, which has essentially been sidelined since Q3 of last year and Q3 of this year. The other thing it's forced us to do, particularly in California, is verticalize. As dispensaries, have been hit by riots, have been hit by delivery only business versus being able to bring in clients, which has vacillated back and forth in California. We thought to ourselves to verticalize there. So in California, I'm happy to announce that as I'm speaking, a press release is going out on the closure of UVI. So we have our first indoor cultivation facility in our system that we're going to begin actively building. And we're doing that, which another press release is just going out with Terpogs. We're also looking at other cultivation assets in California. As you know, we have now manufacturing and oil capacity with UVI. We have cannabis processing capacity with UVI, and we have a large campus now in the Emerald Triangle, in the heart of the Emerald Triangle in Ukiah. And that's going to really help us because physically our distance between our Oregon headquarters and our Ukiah headquarters, as the crow flies, is a couple of 100 miles. The other thing we're planning to do is get into the dispensary business in California. We really can't do this in Oregon. We're just too large, and it would alienate some of our larger customers in Oregon. But in California, while we're still smaller, say a top 20 player in the into the B2B dispensary sales business, we're finalizing our plans to, we're looking probably now at, close to 15 to 20 dispensaries that are for sale in California. And we're looking to open our flagship dispensary in Los Angeles, hopefully by the end of this year. And we're planning to commence build-out at that NoHo dispensary in Q3. So again, to recap what I'm saying about North America, we have California, we have Oregon, In Nevada, we have licenses, one that we've fully paid for, that we're waiting to transfer, which is a manufacturing license, and a cultivation license that we have optionality on. In Nevada, we're also looking at pursuing joint venture opportunities or outright sale of those licenses. We're leaning more towards joint venture opportunities at this point, like we've successfully done with Terpogs, now in California and in Oregon, like we've successfully done with OGDNA in Oregon and in Lesotho. We're looking for a joint venture partner of that status also in Nevada. Turning away from North America, and yes, we are actively looking to enter Canada through the acquisition of Kush Bar from High Tide and those development permits. But when we look at Canada, we're looking at doing it front to back as opposed to back to front, because in Canada, it seems that the dispensary players, Fire and Flower, High Tide, and others, are performing relatively better than their manufacturing and cultivating peers. A big focus for us now, and it seems to be a big focus that you as shareholders who are listening are driving us towards, is international. We need to put a lot more effort into our international business. And right now, honestly, it's tough. Just South Africa airspace, we were hoping this Sunday when the president of South Africa announced phase 2, that he would actually open up the airspace to commercial travel. It's my understanding that he did not. So we're looking now at bordering countries of South Africa in order to fly people in and out of Lesotho as we need them, and then transport them over land into South Africa and then into Lesotho. For those of you who don't know, Lesotho is landlocked, and all port of entry and exit come through South Africa. So when South Africa says that their airspace is blocked, it blocks Lesotho's airspace, as well as because Lesotho does not have many flights, if any, from other jurisdictions other than South Africa. I believe they don't have many or any, for that matter. So there's a much more emphasis on Buffalo and international. Buffalo is really simple to us. We're cultivating there. We continue to grow. Now we have a large order from MedCan in Malta, and effectively we need to do two things there. We need to secure funding with that order in hand. Louisa, now our chairperson, the closing behind us. Louisa's having an aggressive go at getting that funding done over there. Then we need to get our GACP certification, which I personally and Andreas are working on every week. We hope to have that within, let's say, 8 to 12 weeks. And then we're off to the races selling product from Buffalo. CanMart, a lot of you have asked, is really critical to us because, again, as I say, we narrow our scope to Oregon, California, and potentially Nevada in the United States, and then Canada through the dispensary acquisition, and then reversing back in systematically into listing our products and selling them off to other dispensaries. Obviously, we'll have a good relationship with High Tide after this acquisition of Kush Bar. So that will be, I would say, in the medium term, something that we're also looking at. The same way we have to focus ourselves in our international pursuits. We have Lesotho, we have Buffalo in Lesotho. Arguably, it's one of the largest licensed grows in the world, if not the largest. We have to execute on that grow. You're not going to be seeing us buying other international grows abroad. Lesotho will be our base, and then we need to export. We need to export into Europe and the UK. Having CanMart is critical in that pathway, and then also looking at the UK, at the EU continent is critical. That initial order with MedCan, we hope to get other orders within our system as well, but that's a large enough order for us to fulfill over the next, let's say, through the end of 2021. The one thing I'd like to favorably report is that CanMart is now live. So when we started the deal with CanMart, they were not live. They were licensed and ready to go. They are importing product and they are selling product to pharmacies who then deliver them to patients. We also are looking at some serious executive role changes to have more of an emphasis on international. And when we close CanMart over the next few weeks, we'll have a good base in the UK. We have a great base now in Lesotho with Buffalo. So we're feeling very bullish on the international business and looking for significant contribution in 2021. So in terms of what I would call the three strategic focuses in the short term for the company is to close CanMart and the G-Easy deal, which is called Feel Better. So we have a high-end product line to complement Hush and the Terpogs, what I call professional product line that we'll be developing, and securing institutional or bank funding for the Buffalo expansion, as well as GACP certification, and then consolidating and growing market share in Oregon and in California, looking to expand ourselves now that our manufacturing, our indoors check the box, looking at outdoor greenhouse cultivation in California, probably in a joint venture, and then also looking at acquiring more dispensaries within California to verticalize. Now I'm going to turn it over to Philip. A lot of people have been concerned about dilution, but they don't understand the concept of acquiring things to be accretive. Some shareholders have also mentioned to me that they feel that myself and Philip and Andreas, from time to time, taking his salary and shares is dilutive. In my opinion, that aligns us with the shareholders. And as a shareholder, not as a director and as an officer, speaking in my capacity as a shareholder, I believe that the current market cap of around 70 million Canadian does not even adequately reflect the value of Buffalo and the potential there, least of all Oregon, California, potentially Canada, the UK, and other assets we have. But now I'm going to turn it over to Philip, and then Philip will delve into the results and also talk a little bit about this whole concept of dilution and how we view it, as many of you have concerns about it.
Okay, thank you, Kiran. Before I do my presentation, let me just go into the subject that you just touched upon, the dilution. So the way we look at it is as follows. In this year, 2020, we have issued, in relation to acquisitions, we issued 183 million shares. And we break down our portfolio in three components. One is IP assets, and they would be like what happened in Q1 and Q2. There would be nasal Benoit, Canal Lift. They are platforms that are going to enhance other businesses. That represents 31% of the portfolio. Then we have developing assets, and that is, for example, Buffalo. Buffalo represents 35% of the shares that have been issued so far in 2020. Why is it developing assets? So far in Buffalo, we have capitalized all costs until we are going to harvest. So once we're getting closer to harvesting and putting the plants in the ground and then develop it, then it will no longer be a developing asset. It becomes a cash-generating asset. But right now, we put it there. And then we have the revenue or cash-generating assets, and that would include, for instance, MDT. That would also be Crimson and Black and NoHo. and when we close it, UVI will be included there too. That represents 34% of the shares that have been issued so far this year. So it's pretty kind of broadly evenly done. Now, about a third in IT, about a third in development, and about a third in cash-generating assets. So now, if I take the shares in issue right now, which is 542 million shares, and I look at the shares issued in relation to the acquisitions that we did so far in 2020. Including what we have announced as subsequent events, then I get to the 183 million shares, and basically the shares before acquisitions, that number would be 360 million. Now, at the current share price of 12 cents Canadian, the pre-acquisition value of the company is $31 million. At the current share price, the value of acquisitions is 60 million. But the capital invested for those was 32 million, plus the total capitalization of the company is $48 million. So like the 48 minus the 31 or 32 gets you to the 16 that acquisitions are valued at. But actually the capital invested in those acquisitions is double that. So that is there's an anomaly there in the valuation of acquisitions or of the current operations, but we think it is it's the acquisitions. To give you some background, the value of IP right now of that portfolio is $9 million. Developing assets are, and that's Buffalo, we acquired it at fair market value at $6.2 million, and for the cash generating assets, MDT. 5 million, Ukiah 7.6 million, and Crimson and Black 4.3 million. And that's what explains how we get to the 32 million, which right now is valued at 60 million. So acquisitions are undervalued. That's one thing. Now, number two is that would only correct the current situation. Now, when we look at the IP platform, for instance, Canalift, Galactic, Nasal Benoid, we have others, IQDAP, etc. They don't do anything right now, but we acquire them as software and e-commerce platforms to enhance the current businesses that we have. So they will add to other companies, and just to make them non-dilutive, they represented 14%. All of that represented just 14% of the increase in shares. So if we can get a return on that investment in total of 9 million or 14% or more, it becomes non-dilutive, and that shouldn't be a hard task over time. Then MDT. MDT is a cash generating asset. That's just an example. MDT, when we acquired it, only added 5% to shares. So at the time it was dilutive, but now MDT generated revenues of 423,000 in Q1. MDT generated 1.1 million revenues in Q2. So it's really growing very fast, and its margins are improving. And we kept them low purposely because we were using MDT for now as a platform for other products to come in. So we gave discounts. That will start to disappear. MDT gets scaled up. MDT is going to work with UVI in California, and therefore we should expect that margins at MDT will continue to improve as we have already seen between Q2 and Q1. And also knowing that although it's only 5% of shares and of share capital, it's actually already 16% of revenue. So once we get this one right, it will very quickly show how undervalued it is. Buffalo added 50% to the shares that had to be issued in total. But Buffalo, once it harvests, the value of just that one harvest, the cash flow of that will be more than actually the capital that we invested in in Boffello, which was 6.2 million at fair value. I mean, we're talking about more than 7 million if we have a harvest next year, and that will be just one harvest. And Boffello is not expected to do one harvest. So once we get Boffello out of the developing stage and we get it into the growing, maturing, and harvesting phase, we're going to get a lot of cash flow out of Boffello, which is really not discounted at all in the valuation or what we paid for it. So I think we got a really cheap acquisition here with a lot of potential to make the entire company cash flow positive. And those are just a few examples of how it shows how acquisitions that we've done are not appreciated by the market or are not valued the way they should be. But in the end, the market will figure it out, and we should expect it to be corrected. And that's just so far on just to deal with the dilution. It's the cost before the benefit. Like we've done all the work. Like we started in Q3, Q4 2019, issuing all these shares for acquisitions that came through in Q4, Q1, and Q2, and we're getting there. Like we still have a High Tide, Flower Shop, Canmart to close, but then we're getting there with what we have communicated so far to the markets, and all those costs have been taken, and very little to nothing has been discounted actually in the valuation. So as we start performing with these assets, we would expect that will enhance the valuation of the company, and they become accretive and value enhancing for Halo as a company. So that's about dilution. So we think it will be dealt with. After dilution, the operations will catch up and they will outdo the dilution. That's the premise. Then turning to the presentation just of the results. We had a lot of change between, let's say, the first half of this year and what happened in 2019, and that really started Q3, Q4 2019. So we believe that right now, to reflect what's going on with the company, is the growth comparison is easier or better or gives more insight in comparison with Q1 than it does with Q2 2019. But we published all the numbers anyway, so you can see it for yourself. Anyway, just turning to revenues. Q2 revenues were 5.2 million versus 4.5 in Q1, an 18% increase. And that was really thanks to good progress at A&M in Oregon, and also the contribution of MDT, which wasn't there in 2019. That's one example, but it showed a really good improvement from Q2 to Q1. Then to give you some more insight in the developments of Q2 to Q1 in terms of sales, revenues, how it's constructed. Volumes were 1.1 million grams in Q2 versus 1.45 million grams in Q1. So there was a decline. Now, why is that? Because in Q1 we sold 813,000 grams of flour, and we only did 270,000 grams in Q2. And there's nothing wrong with that. It's just that we still had from our own grow, we still had harvest to sell, which we did, but it basically it's a cyclical business. When you have an outdoor business, it's cyclical. And that's really what you see here in these results. Now, extract sales or volumes actually increased. The extracts increased with 25% quarter over quarter. So that was good. Now, if you take all that together, then you have a price mix that actually improves. Why? Nothing happened really. Well, prices in extracts in Q2 over Q1 increased 7%. Nothing happened with flour. That's $1.07. But we had a strong improvement in pricing of 57% in Q2 over Q1. Why? Because we sold less flour, and it's a mix effect. So as you sell less of something that has a lower price and the other one grows, then your mix price starts to move up, and that's really why we show you a 57% increase in Q over Q pricing. I hope that makes it clear that it's the revenue development is a mix of volume and price, and because we have so many different things and also in different markets, it is always there's a mix effect both in volume and in pricing. Now turning to A&M. A&M increased its revenues Q with 46% to 4 million. So that was a strong improvement. Volumes declined actually. So although we had a very strong improvement of revenues, volumes declined with 33%. Why? Because of what I just told you. Is because in A&M we have the flower sales, and flower sales declined with 65%. So the price at A&M improved, but the volumes declined. Overall, we had a 46% increase in revenues. Then gross margin for A&M. The gross margin was 29.1%, and when you exclude the loss on biological assets, the gross margin was 32.1%, and that compares with 23.8% in Q1 2020. So there was an improvement, and that actually compares very well with Q2 2019, where it was 3.5%. But basically, you can see that A&M is on an improving trend quarter after quarter. The improvement in the gross margin between Q2 and Q1, amongst other things, what mainly reflects a shift to higher margin products in the total mix. Then HLO. HLO is in run-up. Volumes declined 98% between Q2 and Q1, and that's it for Halo. There's still some overheads, but it's in run-up. Coastal Harvest. Coastal Harvest had no activity in Q2, but as Kiran mentioned, it's being ramped up to start the Berg distillate program again in Q3. And that's one of the reasons that I'll get to later, is that we had to keep a basic infrastructure in place for Coastal Harvest. That of course doesn't help your OPEX when you don't, or basically your EBITDA when you have no revenues. But that has to be because we have to be ready to gear up again. And MDT. MDT proved to be very good in Q2. It generated revenues of 1.1 million. Versus 423 in Q1, so it's a 166% improvement Q over Q. Gross margins improved, but they were way below still what we think they should be, for reasons I mentioned, which is basically we gave discounts, which we will do no longer, and we're scaling up the mix. So the gross margin of MDT is expected to improve from here, as it already did from Q2 to Q1. Little bit of detail. MDT sold 120,000 grams of product versus 37,000 grams in Q1, so a strong improvement. The price that it sold at was $10.09 versus $10.38 in Q1. There was a small decline in live resin prices, but the main effect really was that within the mix, it sells distillate and live resin. Live resin grew faster than distillate. That had an impact on the overall mix price. And once UPI is added to the mix, I think we will have a very strong presence in California. Operating expenses, they showed a very good improvement. OPEX in Q1 was 4.99 million versus 7.2 million in Q1 2020, so a very strong improvement. A lot of that I've talked about it in the past, and we always mention it in the MD&A. There's a high component of non-cash elements in OPEX. So when you adjust for that, then OPEX was actually 3.7 million in Q1. In Q2, and it was also 3.7 million in Q1. But Q1 OPEX includes a a reversal in G&A of 286,000 at A&M. We wrote about that in the MD&A in Q1, which was a reversal. So once you adjust for that, and actually operating expenses on an underlying basis, they show that Q2 was down versus Q1, so the trend was good there. The big components are always professional and corporate. Professional declined from 1.4 million to 1.4 million from 3.5 million, and that's really reflecting the fact that M&A activity came down because we've done already a lot of it, so not so much in Q2 versus Q1, and that helped. Then investor relations, they were 1.3 million in Q1 2020, and they were flattish, like $9,000 in Q2. And then share-based compensation, which it's a non-cash item, but it's included in that non-cash, which was 131,000 in Q1, but it was 705,000 in Q2. Then maybe another word on Coastal Harvest in there. Coastal Harvest has an overhead base of it showed in Q2 of $650,000, and in there is a number of about 350,000 in relation to professional, which had to do with the contract that we had for superfiltration to get that implemented. That will disappear. So there will be the cost, there will be the overhead for Coastal Harvests, but we think we can reduce it, but it needs to be there to support when we start the business up again, which we have just started doing. Then in terms of EBITDA, again, it showed a strong improvement Q on Q. The EBITDA, it's a loss still, was 3.96 million versus 7.4 million in Q1. Then if you take the non-cash items out of it, then the EBITDA loss was 2.6 million in Q2 versus 5.8 million in Q1. Looking at the operations, A&M was EBITDA positive. HLO is in runoff, and we just have to make sure that the overheads disappear there. Coastal Harvest, it will have to have an overhead, but as it starts to generate revenues, those will offset. And then we have corporate. Corporate was reduced from 5.7 to 2.68 million, and adjusted for non-cash items. I mean, a lot of consultants were paid in corporate are paid in shares. The overheads were 1.7 million, down from 5.6 million. So corporate, we'll be focusing on that, has been reduced a lot too. So that about EBITDA. EBITDA basically has shown it's still a loss, but it's on the right trend, and it's just getting better each quarter. Cash flow. The cash flow used in operations was just over 1 million, 1.1 million. That's the use, and then that was a substantial improvement over Q1, where we used 2.4 million in cash. The working capital development within that, there was an increase in Q2 of 500,000 after a decline of 1.25 million in Q1, but we're building up working capital again slowly, as we have been using a lot of it. But having said that, there's still a very healthy working capital balance that I'll get to later. Proceeds from finance for 240,000. The available cash is 1.5 million. We have a credit facility of 14 million Canadian. So the total funds available for the company to run its operations is just under 12 million US. The cash burn is 347 in Q2 versus 750,000 in Q1. So that showed a big improvement, and that would put us on like 31 months of forward funding for the company. I don't say that that the cash burn in Q2 is the cash burn going forward, but the trend on cash burn has been improving, which is again positive. Then very briefly on the balance sheet, net debt, 6.7 million. The net debt to equity is 23%. In Q1 it was 18%, so still a pretty healthy balance sheet. Working capital, 6.95 million versus, as we had current assets of 16.2 million and liabilities of 9.3 million. And then one word on the share capital structure. Now we issued in Q2, 187 million shares. The share capital increased with 19.6 million to 87.5 million. Share increases, mostly the majority was from acquisitions. I mentioned the number of 183, but in Q2 it was actually 108 million. But we had post June we had some more, and then the rest is from private placements, share-based compensation for staff, services, finder's fees, and some conversion of the debt. And that concludes my presentation so far.
Great.
Katie?
Yep. So we have a couple of questions that we would like to take the last 15 minutes to answer. If you have a question, anyone that's listening, please feel free to submit that question, and hopefully we will have time to answer everything. Okay, so with that being said, Kiran, this question is regarding the $30 million offtake for Buffalo and whether there's capability to fulfill this offtake. Can you answer that question?
So there is capability today to fulfill that offtake over a 7-year period. That being said, Medcan has expressed to us that they want that offtake fulfilled given the demand they have in Europe over the next 2 to 2.5 years. In order to do that, as I said, we need to either deploy capital from Halo. As Philip says, we have about 14 million, I'd say about what he said, about 12 million USD available to us at this point, and our cash burn is going down. I think that given Louisa's background, she is now our chairman, and I'm happy to say that, we have the first Black African woman as a chairman of a publicly listed cannabis company, to the best of my knowledge. So I think the GACP, getting some funding in there, and then getting some people in there is all going to help towards execution. So right now we have product to ship, but we don't have product over the next 2 years to fulfill that contract. Over the next 7 we do, and we just need to grow into it. And, historically we've always been good at doing that. So it's not something that I'm losing sleep over.
Great. And then this next is sort of a follow-up on Buffalo. Kiran, you talked about the bank. It says the bank department, but maybe it's bank account, not sure. But for Buffalo a year ago, is this still in the works?
Yes. So Louisa, so people don't know Louisa's background. I mean, she is a private equity. She runs a very large private equity fund in South Africa. She is very deeply rooted in the African, let's call it, banking, institutional equity, and private equity communities. She's effectively said to us what she needs to be able to undertake a fundraising exercise during these times. We're providing her those things that we need, which is getting that GACP. We've obtained an offtake. We've actually successfully produced product that is flawless and clean. So she has, not flawless, but I mean no mold, no pesticides, clean product. So now, given her background, I'm fairly confident, if not highly confident, despite these challenging times, that she's going to be able to raise that money, hopefully within the next 3 to 5 months.
And then this next one is still regarding Buffalo. Do you have a build-out plan, or are you flexible to meet upcoming demand?
So we have a very detailed build-out plan. Andreas Met, our co-founder, COO, and director, has been very active with it. We have an issue where we've made a deposit on a 1 hectare greenhouse, and that is sitting in, I believe, Australia or someplace, waiting to ship. We have alternate plans to do, California-style hoops, and we keep putting them up until that large greenhouse ships. We just keep growing that operation right now as aggressively and as best we can. But to be quite honest, there have been challenges in the past, and there are challenges in the future, just even with the physical movement of people and goods in and out of Lesotho at this point, given the COVID pandemic. True.
So this next question is regarding CanMart and the timing and why it is overdue.
So CanMart and the timing, as I said, is over the next few weeks. And again, to be frank, I mean, COVID has affected us and affected CanMart's ability to close this deal. And now everything is sort of on track. The agreements are pretty much finalized, and we're actually working with them actively on our Slack channels and what have you, operationally as well. So inevitably, the vision is to be able to grow very high quality OG DNA genetics and our standard style cannabis in Lesotho at GACP standards, ship that into Europe through Malta and Medcan, and then inevitably when people transform it into CGMP medicines, move those into the UK, which would give us a substantial competitive advantage over any and all competitors there. So, I mean, that's the vision. That's the vision for 2021. So, yeah, CanMart is a critical piece to us of that vision, and I think it's one of the only few distributors in the UK of cannabis medicinal products that can say that they're active and effectively making sales to pharmacies.
And then we have a couple for Philip, but before we get there, Kiran, there's one more regarding the stock and the range that it's been trading in, and whether it would make sense to consolidate the number of shares in order to get the share price higher in a quote more serious range. What are your thoughts about this?
We have no intention to reverse split or consolidate the stock. I mean, to be quite frank, people don't invest in a company like Halo when they can invest in a company like Apple or Facebook or a tech company and maybe get a double in a year. People are looking at Halo to do a 5 to 10xer, what many investors have told me. And a lot of people, including me, sort of view the stock at 10 cents as a call. So if we execute the way we should execute, our multiple should rise up to the level of other MSOs. And if that does, if you just look at an apple-to-apple basis, the stock should be trading around 20 to 25 cents today. And so, if we continue this positive trend that we've seen in Q4 to Q1 to Q2 to Q3 to Q4, I think this stock can substantially appreciate.
Okay, good. So Philip, these next questions are regarding first, when Halo will be cash flow neutral.
Right. I think with everything that we're doing right now, I think it's fair to say that in Q4 we should be cash flow and EBITDA positive. Yeah, it's A&M is already cash flow positive. NDT is improving rapidly. Taking Coastal Harvest from a standstill to actually growing again. Further focus on corporate overheads, and then the new acquisitions that start to add to. Then I think we should be cash flow positive and EBITDA neutral by Q4 this year. Just if you just think about it, and that's not for this year, but it's for next year. One harvest of Buffalo makes the entire company cash flow positive. So
yeah,
I would say
yeah.
Q4.
And so the next, okay, so Q4 of which year, just for avoidance of doubt?
That's the 2020.
Okay. Great. And the follow-up question was, when will Halo be break even? But you touched on EBITDA neutral there as well. So maybe this means full investment. But anyway, is there anything that you'd like to add? The question was, when will Halo be break even?
Yeah, I think Halo will be break even by Q4.
Great. Why is there an impairment for every purchase? That's something that they were asking about.
Okay, it's very much an accounting treatment. When we acquire something, sometimes you have to use an approach that's called the depreciating replacement value approach. And really what you do there is you just try to value everything that's being done to get the asset where it is. But it doesn't really say anything about its potential. So if you had to hire a programmer, if you had to hire this, that, whatever, and it gets you to a certain value, that cost is the value that under IFRS you have to use to value the acquisition. That may not actually be the price you pay, because we think that if we pay more, then it is because we think more is going to happen, or something is going to come out of this. So therefore, there would be there's a difference. Now, accounting tells you impair it, and then as we see it progressing, then we kind of unimpair it. You start to add it back. It's like we had the same issue with NDT. We did we closed the acquisition. We had in Q1 we had an impairment of some inventory. That's just an accounting measure because the inventory is still there, and we alerted to this in the earnings call for Q1. We may actually use that inventory in the superfiltration program, and it will be reappraised. So the impairment could be reappraised. So it's accounting. It's nothing else.
Okay, great. This last one, Kiran, the audience is wondering about old partnerships and if we have an update on them, such as Kaliva or any of the others that you wanted to comment on.
Well, I think people have addressed three specifically. Kaliva, I think, remains a client of the company. I'd have to check with the salespeople in California. As we've mentioned before, we've substantially grown our sales force in California. I think in Q1 we had 1 or 2 salespeople. Now I think we're up to 6 to 8 in California. What else? Falcon. Falcon, now that we're starting to sell bulk distillate, given the fact that 2 out of 3 of their principals are, shareholders of Halo, I think that's helpful. So as we have distillate coming off the lines now in Coastal Harvest again, I think that, that partnership will be re-engaged. We looked at BDS data, and if you add up flower and pre-roll data in California, combine it, it looks like Falcon is probably the number one company in both of those categories. So maintaining that relationship with Jim, Edlin, and Ryan is pretty key. The third thing is that a lot of people have been asking about CBD and Greenie and other of our CBD ventures we announced last year. As a result of our sort of narrowing of focus, we don't have any initiative to go into CBD. That being said, I'm right now pressing the OG DNA guys for some of their high-yielding cannabis CBD strains, because we have a unique position in Lesotho, and the only other place in the world I think you're able to do this is Vermont, ironically, where I can grow a cannabis plant that yields high in CBD, or we can, and THC, and I can strip both. THC I sell through the INCB or UN protocols off to Malta or other African nations, but the CBD is much more of a free market, and that CBD product I can actually even sell into South Africa. There is still opportunity in CBD, but for us to start putting in CBD manufacturing, working with CBD websites is not something that we plan to do at this point. That being said, if we can grow plants and on the same stick, as we call it, or plant, we can extract high levels of CBD and just call it the C-type oils, as well as THC at some point. That's very attractive to us in Buffalo or in Lesotho.
Great. Well, it looks like we've already taken up the hour, but I did want to make sure that no one had further questions. So if the host can chime in here, it didn't look like anyone was in the queue, but it would be nice to confirm that before we concluded.
Sir, there are currently no questions over the phone.
Great. Well, Kiran, would you like to?
Okay, I'd like to thank everyone for attending. We're working diligently. We're working diligent and hard. Right now, despite the fact that a couple of us have come down with COVID, we haven't had sort of a material adverse change to the company as a result of it, nor do we anticipate it. And what we've done is actually increase staff because we're not the type of business where people can stay at home. I mean, we're a cultivator, we have people out in the fields, we're a manufacturer, we're a distributor, and we have direct sales into dispensaries and soon at dispensaries. So we've been very proactive there. With us right now, it's just a question of focus and execution. We've narrowed our focus. Our results, Q4, Q1, and Q2 show our ability to continue to improve on an executional basis. So I thank you all for your continued support, and hopefully we can continue to deliver positive results as we have been doing over the last 3 quarters.
Ladies and gentlemen, this does conclude today's conference call. Thank you for your participation, and you may now disconnect.